Yo, welcome to the liquidity recon, the only liquidity recon that you will ever need in your life. So let's get into it. What is liquidity? Liquidity is basically money in the market. Money in the market. How's money generated in the market? We know that traders like to trade something like this, right? And they'll put their stop loss here because they got in here. This is liquidity, right? When you have this doing this all becomes liquidity, right? Because here, people are putting their stop losses here, people are putting the stop losses here when price does this. So this becomes trend line liquidity. So what liquidity essentially is just where people put their stop losses. People can get in here and put their stop losses here. People can get in here and put their stop losses here. They can get in and put their stop losses here if they're looking for price to go down. Now, why is liquidity such a big thing? Why do you hear liquidity in trading so much? The reason why you hear liquidity so much is because the big players, when they want to enter the market, they need liquidity. Remember, liquidity is money in the market. So if the big players need liquidity to enter the market because their order is so big, we need to take some people out so we can gather their money, their stop losses, right? And then fill it in the big players. Hence why you see moves like this. We do this and then we do this. Taking this point here is the stop losses, money. A lot of traders put their stop losses here. When that gets triggered, especially if they're in a long, that becomes a sell. So they sell their position. And when you sell your positions, the big money are buying that position. And when they buy that position, hence why you see price go up. So this is why liquidity exists, is to basically fill in the big players. So now you might be thinking, how can I identify the liquidity that the big players want to take? How you identify it is liquidity can show up in multiple forms. So let's start with the first one, which is consolidation. Up, down, up, down, up. When price is like this, internally, where we're doing this, people are going to be putting the stop losses here, 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 here. Also, people are going to put in their stop losses here, 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 if they want price to go down. If they want price to go up, their stop losses are below. If they want price to go down, their stop losses are above. Remember this. That is one form of a liquidity pattern, you could say. Another one would be, as I went over already, trend line. Why is this? Because now it's giving people that we should be buying, because we're breaking highs and we're not breaking lows. So the lows are going to have liquidity there because people are looking to get in like this. 1, 2, 3. Do you get where I'm coming from? So when price does this, it's taking all their stop losses, which becomes a sell for the smart money to buy, to fill their orders in. Because remember, they can't just buy because there's not enough liquidity. There's not enough, you need enough fuel in the market for you to come in and buy something. Imagine you want to buy something from store. If there's not enough stock,